You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. Hey guys, welcome back to the Young Investors Podcast. As you can already tell, joined by a very special guest, our good friend, Tom. Investing with Tom, the man, the myth, the legend. He's back once again. You know, we always see a spike on our analytics when you join us on the podcast, Tom. So there must be something to that. We might have to work out a long-term contract for you in the next. How you doing?
Yeah, pretty good. It's good to be back. I don't know why there's a spike in the analytics, but I'll take it.
Actually, no, I'm not even like joking. Like every time you come on the podcast, there's like more views. So it's good. I like it.
Nice.
I feel like...
How you going, Hamish?
Yeah, I'm going well. I feel like the three of us have a pretty good chemistry. And I think especially after, I don't know, I especially noticed this with our US episodes where the three of us are in person. It just kind of works well. And me and Brandon were talking about this the other day as well. Like I think we have pretty good chemistry going back and forth, but having three people with good chemistry on a podcast is like, I feel like that's the perfect amount for just kind of sharing the load kind of thing. So yeah, works well.
Any more than three is just too many. I've watched a couple of podcasts where they have like I'm not even kidding, like 5 to 10 people.
I don't get that.
And it's just hectic. Like sometimes the special occasions like the ones we did for Movember, they worked. But even still, you still get people that end up like not saying anything just because it's just too many speakers kind of thing. But yeah, two people's fine and it's good. But then again, if one of you's flat that day, it can really affect the podcast. But yeah, three is just great. Banter is flowing. One of us has got something funny to say. Anyway, Merry Christmas, everybody. It's not Christmas for us right now because we are recording this ahead of time, but it is, well, I guess it's not really Christmas for you guys either. It should be the 24th, but hope you guys are having a good holiday period. Hope you guys are getting some rest, chilling out, listen to the Young Investors Podcast, of course. And today, what we're going to be doing is we're going to be doing some Q&A. So I asked for some questions, if you guys had any questions, over on my YouTube channel. And we've chucked them all in the doc, and we are just going to start rolling through them. Some questions were very interesting. We might see if we get to a few sus. Of those ones. A little bit sus.
A little bit sus. I don't know what's going on with your audience, Brandon. But
I don't know.
I don't get those questions.
Maybe
I'll tell you that much.
A few for mature audiences. We'll see if we get to some of those. Depends how tired we're feeling in about 45 minutes. But should we? I don't know. Do you guys want to pick one first up, or should I pick the first one? I'll pick the first one. Here we go. Let's start. How about? Let's start here. Let's start at the top. Ducksups, what a name. I would be interested to know how your investing strategies have been influenced over time, particularly with respect to books / people you've been exposed to over time that have changed your views. I.e., you may have started out relying on PEs more from, say, Peter Lynch from One Up on Wall Street, but after following Toby Carlyle, you more closely follow enterprise value. Who wants to take this one? Tom?
Tom, do you want to go?
Yeah, sure.
Put you in the hot seat.
Yeah, sure.
How's your style changed over time?
Yeah, I think the core philosophy of like trying to buy a good business at a reasonable price that was like seared in pretty early on, and I don't think that's really changed. Although the framework for finding those things has probably changed a little. Like, I think all three of us were pretty heavily influenced by Phil Town early on. And I still kind of use that general framework of like, the 4M checklist to kind of work through understanding a business and making sure I've got all the big areas kind of covered. But yeah, other things have definitely influenced it over time, like Monge per Bri kind of opened my eyes to the 50-cent dollar kind of world and, showing that you can make good returns in slower growing or even like shrinking businesses if the price is good enough. And then the other thing, like the most recent evolution for me has probably been paying more and more attention to like capital allocation frameworks within a business. Like it's one thing to buy a company that has a higher return on invested capital, for example, but if they don't have anywhere to now deploy that capital, then the return on equity and stuff doesn't really matter because they can't, invest more incremental dollars at those high rates. And that's where it becomes like nice to have a CEO that understands, when share repurchases make sense or when they don't make sense, when acquisitions might make sense, when they don't make sense, and that type of stuff. So, I think the core framework.
So just like keeping the growth runway open kind of thing.
Yeah, just making sure like if you've got a really good business, generated a bunch of cash, you funnel those dollars that are coming in the door into like intelligent places, basically.
Right.
Like for Berkshire, for example, with Buffett, that's been largely acquiring new businesses, and that's like a pretty rare skill for a CEO to acquire a random like mix of completely unrelated businesses and have it work. So that's been like the general evolution for me, I'd say.
Yeah, and
Nice.
I guess
Hamish?
I guess we get a little bit of that outside of reinvesting into the business from Monish recently talking about Uber cannibals and kind of that as an outlet for businesses to, if their share price is really low, then they can potentially repurchase their stock, and that's like another outlet for them to allocate capital besides reinvesting back into the business or acquiring other businesses. But I think in terms of, I pretty similar to you, Tom and Brandon, I started very much with Phil Town stuff and then kind of evolved into looking at more direct stuff from Warren Buffett and Charlie Munger, which I guess kind of just broadens your understanding of what Phil Town is teaching. But then more recently, I guess, maybe same as you, not with Monish, but looking at other kind of modern takes on value investing and how that's been applied. So for me, that's kind of like Nick Sleep and seeing the specific types of businesses he's looked at. So like scaled economies, shared businesses. So I guess that's how it's kind of evolved for me, from understanding like the framework from like the classic value investing principles and then seeing how different modern investors are applying it today.
Yeah, I think particularly at the start, I really didn't have any background in investing. So I latched on to, Phil Town's books, and it became very formulaic. It was very much checklist, make sure the company is doing this, tick, 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 tick. And I think once I started getting a little bit more comfortable with applying that, I realized that you'll never get every tick on the checklist. It just doesn't happen. Yeah. It just, for one reason or another. So I think I got more comfortable with the idea, and especially listening to people like Monish Pabrai, but even like Buffett, like all those guys really, Guy Spear, is that it's more like each individual, there is no perfect formula. There's just each individual business on its own merit kind of thing. You have to understand the story and why things are happening, as opposed to just, is this number checking this box kind of thing. So you kind of get that sense for, there are so many of like value investing stocks out there, or opportunities, but they will all look probably completely different. I think that was probably the one thing. And then the other thing that I definitely focused on more and more as I went is just like extending the time horizon for my investing. Like I think even though all the books say, make sure 10 years and stuff, I think like mentally myself, I hadn't really quite committed to like at least 10 years. I think I was kind of like, but if it went up a lot in the next 3 years, that'd be really good, right? And I guess this is like Monish talking about, people buying Amazon back in the day or whatever, like 20 years ago or something like that. And just seeing some of the returns in these businesses over time, just like, yeah, sure, it's nice. It'd be nice if you made a boatload the next 3 years, but just really thinking about, okay, what about this business in 10 to 20 years, and really committing yourself to a longer term approach, I think was probably pretty influential for me. But yeah, I think those would be my two main things of how things have slightly changed. But yeah, you do, like you said, Tom, you do get that framework pretty early. Once you kind of tap into the Buffett framework, I don't think that ever changes, right?
Yeah.
Do you think that will ever change? I don't think you're fundamentally going to invest differently.
No, I don't think so. I mean, you have weird special situations and stuff come up, but like you're always trying to get more value than what you pay for, I guess, as Charlie would put it. So
yeah, no, exactly right.
It is kind of funny.
Hamish, pick another one. Oh no, you got something to say.
I was going to say it is funny because some people, I guess it does come back to what a lot of value investors say, which is it's kind of your maybe it's like a biological thing, because I think a lot of people just tend to find themselves jumping from strategy to strategy over time, over like a 5-year period. Whereas I know all three of us, as soon as all of us learned Graham or Buffett style value investing, it just kind of clicked and we just kind of stayed on that path. Whereas I see a lot of other people who kind of just tend to jump around, or they go from this, they go to small caps, now they're a dividend investor, now they're a growth investor, and it seems like they haven't kind of settled on an idea or a set of principles. Whereas as soon as I read I think it was Phil Town stuff first, but then certainly as soon as I read Berkshire Letters, I was like, oh, this is like, it was like I just discovered something that was like, I shouldn't be.
It makes logical sense.
Yeah, it just made perfect sense. So it is interesting that.
Yeah.
All right.
It's good when you hit those. Oh yeah, you go.
No. What are you gonna say?
Pick another one.
Okay.
I was just like, it's good when you hit those situations where you just like you can't really refute anything. It's just like, yeah, that makes sense. Oh yeah, I mean that makes sense. Yep, that also makes sense. Okay, better do it like this. Yeah.
Yeah.
Right.
Sorry guys. We're working on a bit of a delay here. We've got
bit of a delay.
We're it's so much easier to do these in person. So hopefully we can do that at some point in the future. But for now, you'll have to put up with us kind of jumping over each other,
tripping over each other.
As we,
Wait, what was that, Hamish? Oh no, so me? No,
All right, we'll just I'll skip a couple and we'll go down here. This is one kind of directed at you, Tom. How do you combine a full-time non-investing job like Tom with doing in-depth research of companies? How have you kind of found that?
The short answer is I probably look into a lot less companies than I'd like to because I have a full-time job. That's the true answer, really. But just making the time to do YouTube content and study investments and that kind of stuff. Like, it's what I'm into. If I didn't have a YouTube channel or whatever, I would still be, spending some time on the stuff. Like some people might go watch TV or watch Netflix or whatever. Like, I woke up first thing this morning. This is going to give away the date that we're recording this podcast, but woke up first thing this morning and read the Thor Industries quarterly report for like 45 minutes in bed. So that's just kind of like that's where my personality is sort of at with this stuff. So I'm just kind of really into it. The short answer is I just look into less companies than I would probably be able to if I was, if I wasn't working full time or whatever. Any
takeaways from Thor? You're not there yet.
Oh, Hamish,
you guys can talk about Thor.
Yeah, Hamish and I were going back and forth on this a little bit today. So, Thor's a RV wholesaler, for anyone that's unfamiliar. They had like a big boom over the past couple of years with the pandemic and cheap financing and various things. So I think revenue for the quarter was down something like 20% year over year, and earnings were down about 40% year over year, although about 50. Yeah. So they're eating through this like huge order backlog they've had for a while pretty aggressively now. But they still generate a lot of cash. Like I used to be invested in Fiat Chrysler, for example, which was the type of business where if you had a 5 or 10% reduction in revenue, you'd suddenly go to like earning, razor thin net profit margins to like burning cash like you wouldn't believe. And and Thor, I think, has something like 80% of their cost of goods are like variable costs. So as revenue comes down, they can drop a lot of costs out and still produce cash flow. So like they bumped their dividend 5%. I think they bought back a little over 0.5% of the shares outstanding in the quarter, and repaid a bit of debt as well, even though they're going through a little bit of a headwind. And they're still guiding for something like $8 a share in earnings for the full year, which would put them at roughly a 10 PE, even after all this decline in revenue and stuff. So those were the initial takeaways.
I'm guessing just people aren't buying RVs at the moment.
Pretty much, yeah. A lot of people finance them, so interest rates going up don't help. Higher fuel costs, although they've put out some research saying that fuel costs actually don't make as big an impact as people might expect, but presumably that's had a bit of an impact as well.
Yeah, it's interesting because, obviously they're a very cyclical business, but they are, I believe they're the only public RV manufacturer that has remained profitable through every recession in the last 30 years. I'm not sure about Forest River, which is the subsidiary of Berkshire. Obviously, we don't kind of get the details on how they've performed during recessions. But Thor has this incredible variable cost structure, which allows them to reduce their costs aggressively. And that's something that a lot of other RV companies can't do. So, I think completely expected if you're keeping up with the company, the decline in revenue. I would expect it probably to continue to get worse, at least in the short term, given the significantly higher interest rates. Pretty normal stuff for the nature of the business, and given how insanely good 2022 financial year was.
Yeah.
They had like a massive order backlog, didn't they?
Yeah. What did it get up to in the end? It was like
Thor?
18 billion or something insane. It was like really high.
It was
So they just worked through all that.
basically. Yeah, it's down to low single-digit billions now. I think I don't know the number off the top of my head.
I want to say it's like 5 or 6 or 7 billion or something like that now.
Yeah, but their annual revenue last financial year was like 16, 17 billion, something like that. So they had like a year's revenue of order backlogs for a while there.
Wow,
so it got pretty wild. I saw specifically in the US towables segment, which had been like a bit of a shining light for Thor over the past couple of years, their order backlog was down like 80% roughly.
Yeah, went from like 10 to 2 or something. 10 billion to like 2 billion or something like that.
Yeah, but it's a little weird. Like the European business has been struggling to get chassis. European motorized business has been struggling to get chassis and stuff the past couple of years. So they're still working through an order backlog. Like there's a few different dynamics to the overall kind of business, but that's probably enough on Thor.
Hamish, do you have anything to add on somebody that's looking to get into investing while they also are stuck with a full-time job?
Yeah, I think my kind of approach has always been to build your portfolio around how much time you have to analyze companies. So, I mean, if you only have a small amount of time every single week, you have to recognize that you're probably not going to be able to find maybe a full portfolio of companies that you can keep up to date with. So maybe that means that you only allocate a small amount of your portfolio to the individual picks that you can spend time on, and maybe the rest is more broadly, diversified. So that's kind of how I would think about it, and that's how I used to think about it. I used to have most of my portfolio in index funds, and then I would just spend the little time that I had outside of work and university on trying to find one really good idea, and then kind of broadened out from there. So I think just think about how you allocate your time if it's limited. The same way that even if you had a full work week, you still think about how you allocate your time. It's just it's just you have less time.
Yeah, I think a good tip there is just to stay close to your circle of competence and don't drift too far. Because there are businesses, even if you never read an annual report, you kind of keep up with them anyway, just through your interests and what you do for work and that kind of thing. So that can be handy as well.
The other thing I would say, I think Hamish, you might have mentioned this on a few podcasts back, that I think you've bought like one stock this year or something. I'm in the same boat with one new stock, and have added to some other stuff. Like you don't need to find 10 new stocks a year to build a good portfolio over time. So that helps with the overall time requirements, I guess.
That's true.
Yeah, that's a good point. I think I've about found one good idea per year, but it's certainly not been one each year. I think I didn't invest in anything significant last year. I made some little kind of toe dipping investments, but nothing big. And then in 2020, I was able to pick a few at once because everything was kind of down. And then this year again, one. So there's sometimes years where there's very regularly 6-month periods that go by and I haven't touched my portfolio besides regularly contributing to index funds, which I always do as kind of a foundation. But you don't need that many ideas, and even one per year is a lot if you look at some other for some value investors. Even one per year is way more than they end up adding to their portfolio. But it kind of depends on the specific type of value investing that you're doing as well. I think whether you're doing kind of deep value versus looking for long-term compounders, the frequency of opportunities can kind of vary a little bit.
All right, I want to move on to this question because I feel like we can give some top tips here. I'm planning to do the Berkshire annual meeting pilgrimage this year. If you guys can talk about some details of it, that would be highly appreciated. I wanted to put this one in. We could just reminisce. We can just go back. Oh, those were the days. You remember that?
It's not a cult.
What a trip. It's not a cult. It's not a cult. It's not a cult. It's totally a cult. How good was that? Do we have any tips? I mean, so for those that don't know, I think basically all you guys would know that we went to America together earlier this year for the Berkshire Hathaway shareholder meeting in Omaha. Any tips for somebody that wants to do it? Well, we ran into some issues. First of all, we were not, the date was different for this year's meeting, wasn't it? So that threw us off by like a week or something. We had to wait for it to be announced, and I think the date was slightly different to usual. But also for us internationals, it was quite a challenge to get those tickets in time because basically just Berkshire, if you're international, you just have to get tickets in the post, right? And
although I think you can turn up like the day before or something. We didn't actually end up trying that. You can just turn up and prove that you're a shareholder if you've got a statement from your broker or whatever and get a pass.
Right. Yeah. Okay.
Or everyone because that had spares. That's also an option.
Yeah. Yeah, I mean, it was very like long and it was a messy, like you had to mail them and then they would check you on the share registry and then they would mail back the ticket. And by the time we had taken off to go to America, the tickets hadn't arrived at your house, right?
Yeah, I got back. So we were in the States for 2 weeks, I think, or you guys might have been a little bit longer, but I was basically exactly 2 weeks. And I got back and like the mail arrived basically as I got back with the tickets there.
Right. So 2 weeks too late, basically. Mm-hmm. But Hamish, you found a good workaround where you can just buy them on eBay. So if worse comes to worse.
There's quite a few people that live in Omaha and just get them very quickly and then sell them on eBay. So you can just do that. And sometimes they're really expensive, but if you just wait a few days, usually someone puts them up really cheap because they're getting them for free. Yeah. So if they're not going to go, usually they're listed for relatively cheap, even if you want to get them shipped internationally.
Because you can get 4 tickets per shareholder, right?
Correct. Yes. Yeah.
Well, you could last year.
Yeah.
And it's not, I should say as well, it's not like one of those things where, you swipe a QR code on your phone or anything and it's linked to your like Google Wallet or anything. It's just like a flippin' little card that you just show them. It's just like a lanyard.
Yeah. And I mean, that's the annoying part of it because if it was just digital, we could have got it immediately. They wouldn't have to physically mail it to us. It is, I mean, obviously getting the card is cool and it's like a nice souvenir, but, it's not exactly Buffett's not exactly up with the latest tech. Let's just say that.
What's a QR code? Munger's like, I think Ticketmaster's like trading turds. I don't know. Any other tips? What tips can we give somebody that's looking to go?
Do you guys think,
with our long experience?
Do you guys think if we did it again, we would stay a little closer to the venue?
I was going to say, stay in the city. Stay safe.
We didn't realize that there were some areas of Omaha that seemed like they were slightly higher crime. I mean, we should have anticipated something like that. I mean, we live in Australia, New Zealand, so we don't really have to worry about like guns or, that kind of violence or anything. Not that we actually saw anything while we were there in Omaha. I'm sure it's a very nice place. But from the general vibe I think we got from Uber drivers, people we spoke to, is that there are definitely some areas that you probably don't want to kind of be out after dark. There's some neighborhoods where you just kind of don't want to go. So I think, if we had our time again, we would probably stay closer to the city, I think. Thoughts, opinions?
I think so.
Yeah, I think go on. Go ahead.
I was just going to say, like, about 2 weeks or something after I got back, just out of interest, I looked up because there's a Marriott and a Hilton straight across the road from the CHI Health Centre where the Berkshire meeting actually is. I just out of interest looked up, how much a room would be for the following like April, May to book for the Berkshire weekend. And I think it was already sold out like a year in advance.
Whoa.
So
damn.
You'd want to get onto it like now, I reckon, if you're thinking of going, just book something.
But when do the dates get announced, or do you just assume it's going to be the same date?
Well, the date was on the It was announced at last year's Berkshire meeting. Like, it was on the back of the passes and a few things, I think.
Oh, was it? So we already know the date.
Sure. I'm pretty sure, yeah.
Oh, okay. I've made a blunder there. In that case, Hamish, we should definitely get on that.
Well, even regardless, if we can't stay at one of the places that's right across from the venue, I mean, I think at least next time, even if we're booking an Airbnb or something like that, we will be a little bit more. I shouldn't say I will be a little bit more selective about where we choose, because I didn't. I'm just a cheap guy. I just looked at the cheapest one and selected it, and that probably wasn't a great decision.
I think we were a 10 or 15 minute Uber ride from the venue last time, right? Roughly.
Yeah, roughly.
So presumably you could get a lot closer if you somehow manage to pay up some huge price and get into the Marriott or Hilton. That's where you'll run into the likes of all the super investors and Bill Gates and so on. That's where they seem to hang out. If you can't get in.
Do you got to tell your story about Bill Gates, surely?
I think I've told that before, haven't I?
Tell it again. It's a good one.
Tell it again. Yeah. My girlfriend's dad was joking after that, saying like, Bill Gates almost got to meet Tom Boddicker. It was crazy.
Yes.
That's exactly right.
I was leaving the Aquamarine dinner, so got to go to Guy Spear's like fun dinner, which was super nice of him. He did not have to do that. Was just waiting for an Uber, like standing in the foyer sort of area of, I think, the Hilton, one of those two hotels. This van pulled up, dude jumped out with a couple of security guards and just like boosted straight into the hotel past me, and it was Bill Gates. So
nice.
Saw him in the flesh. And then about 30 minutes later, Monish Prabrai posted a picture on Twitter of him and Bill Gates. And I think he must have got a photo with him like right then as he was walking in, because it looked like it was in the same building. Yeah.
Oh, wow. That's crazy.
Yeah,
Did you say, hey, Bill, have your microchips back?
Yeah, you should have had your cake ready to,
the pie.
There was a few moments on that trip where I was like, I'm just living in a simulation. This can't be
real.
Yeah.
It's pretty cool, wasn't it? The amount of stuff we got to do. I mean, you really hit the jackpot. You got to go to the Aquamarine dinner. I mean, you're like best buds with Guy Spear now.
Am I?
But like even just like us sitting next to Lee Lu just across how crazy was that?
Insane.
Yeah, so many cool things. I really wish I got a photo with Tim Cook though, but I was just Brett got one, but I did not, but that's okay. All right. Hopefully that answers that question. Any other things we can think of? Not really.
Give yourself a day or two either side for the surrounding events, because it's not just the Berkshire meeting. That's the other thing I would say.
That's a good point. There are so many like fun like dinners or barbecues or this and that events, even like content creators doing stuff, all sorts of things. So yeah, definitely. Yeah. What did we arrived a couple of days before. We left like a week after because we just planned to spend the week in Omaha just working on making content. But yeah, I think you're definitely right, Tom. A couple of days before, a couple of days after.
Yeah, I think just keep an eye out on like as many random investing places as you can, because people just book events ad hoc. Like we went to the Guy Spear William Green meet and greet. One thing that is regularly scheduled every year is the Markel brunch. That's always the Sunday morning after the Berkshire meeting. So you can go grab a free breakfast and listen to Tom Gaynor's kind of Q&A. So me and Hamish did that this year. That was pretty cool. I think the We Study Billionaires guys, the Investors Podcast, are having a few events as well. So maybe keep an eye out for that. I'm sure there'll be lots more that starts to get advertised as the date gets closer.
All right. Should we move on? Hamish, you got anything to add?
No, that's all. Let's go.
Nothing to add, Charlie?
Nothing to add. Yep. All right. What question should we do? We'll do this one. We'll just keep going down the list. Can you put together a portfolio of 20 high return dividend stocks that could beat, say, Vanguard high yield, or is it easier just to stick with them? So, Tom, can you build this guy a portfolio?
I would say no.
No.
I just don't know enough about dividend stocks, really, honestly. I don't know, Tom?
I don't know what's in the Vanguard high yield. I am 100% certain I could give you a portfolio with a higher dividend next year, but it'd be a collection of random mining stocks paying like 30% dividend yields that'd probably fall off a cliff the following year. So,
Have they found gold yet?
Yeah.
No, still no. Bugger.
Exactly. Yeah, I know there's some Aussie coal stuff that's probably going to pay like a 50% special dividend and things this year, which is actually kind of interesting. But there's I think probably what you're searching for in that type of structure is like a stable growing dividend, I would think. So we're probably not going to be much help there.
No,
high dividend yield ETF. Sorry, Hamish. Yeah,
even just selecting 20 different companies. I mean, I don't even think I could find. I mean, maybe it's different if you're looking at dividend companies specifically, but there's no way even if you just asked me to pick 20 different companies, I don't think I would be confident in 20 different names. I mean, the list of companies that I'd be really confident in holding in a portfolio is far less than 20. That's for sure. So. Even if that was if I had to pick 20 and it had to beat the index, I would be far less confident if you said pick 10 or pick 8 and beat the index. Yeah.
All right. Dividends are overrated anyway.
Exactly right, Tom.
Yeah, they're not great.
Exactly.
You have to reinvest them. So
boring.
Where's the fun in that?
Oh, dividend investors going to give us some hate in the comments. I found the Vanguard High Dividend Yield ETF, VYM, and I would like for you guys, I should say these are American businesses. Can you guess? So I've got the top 10 holdings. AT&T. Can you guess? AT&T is not a top 10 holding. There's a couple in there that
are they all like S&P companies?
Johnson & Johnson. Yep, you've got one, Tom. Well done. Johnson & Johnson is there. It's number 2 on the list.
What pays a high dividend? I don't even know.
Verizon.
Verizon is not on the list. There is some pharmaceutical companies. There is some oil companies.
Pfizer?
Chevron.
Pfizer is on the list. Chevron is on the list.
Oxy.
Give me another oil company.
Big
boy.
Oxy?
Not Oxy. Sorry?
Shell?
ExxonMobil.
No. ExxonMobil. Yeah, you got Exxon. Yep. There's a couple other. I'll read you the list. ExxonMobil at the top, Johnson & Johnson, JP Morgan, Chevron, Procter & Gamble, Home Depot, Eli Lilly, Pfizer, AbbVie, Merck. There you go.
Right.
Nice. Just as a
could we make – sorry, yeah, you go.
I was just going to say, as a very random aside, I'm currently reading the autobiography of the Home Depot founder. I think his name's Bernie Marcus. That book is very good. That highly recommend. Yeah.
Okay.
That's cool. A cool one.
I like those books that are kind of about a specific business, not just like I like business books in general, but like when they really hone in on a founder, or like the Bob Iger book I really liked. That one that you recommended, Tom, about Alibaba that I read, that was really good. I like those sort of ones. Hamish, you read one about Netflix, didn't you?
It wasn't a founder book. It was more about different competitive advantages.
That was the seventh.
There's one, the Texas Roadhouse one.
Texas Roadhouse.
His name is I'm blanking on his name at the moment, but that was a really good one. Yeah, Home Depot is an interesting story. I presume the book kind of goes through the founding the company and. Yes, it is interesting because that duopoly between Home Depot and Lowe's has been around for so long. And I don't know all that much about it, but I know a little bit about the different strategy that they kind of like. Home Depot focuses a little bit more on kind of consumer DIY, and Lowe's focuses more on the professional customer. But they both serve both, but with like a slight different focus and store layout and that sort of thing. And it's just interesting to kind of see how they've different times that each has been on top. Like Lowe's has been on top, Home Depot's been on top, and they've kind of been like this battle back and forth.
Yeah, I started reading this book and I specifically thought, this is a company that Mr. Hamish Hodder would love as I was reading it. So I think you should check it out. It's a lot of similarities to like a Costco, like warehouse style, everyday low prices. It's quite interesting, like some of the training programs and that sort of thing they have for staff to kind of upskill them to like help people out to do their DIY projects and that type of thing. It's a really interesting story.
Yeah, I spent a bunch of time looking at Lowe's and Home Depot. I think maybe middle of last year or something like that. And I think the share price for both of them has been, I'm not sure what, I haven't looked recently, but they've been relatively high most of the time, probably partly because they're paying out that massive dividend. So it hasn't been super attractive to me on a valuation basis, but the businesses are certainly fascinating in the industry. And it's always interesting to look at kind of a duopoly that's been dominant for an extremely long period of time. So
yeah, it's one of the rare retail type things that's managed to completely just like burn through the Amazon risk that's killed a bunch of other retailers as well.
Yeah, it is interesting because I mean there will be some evolution for e-commerce, but by and large, a lot of it there won't be too much evolution. Certainly to not the same extent as other parts that Amazon has been able to cannibalize or steal market share really easily. So it is an interesting kind of unique case. I'm not super familiar with the property and construction industry, so maybe that played a role in my hesitance as well. But it's certainly kind of a fundamental part of society that you wouldn't imagine is going to go away anytime soon.
Yeah, and I think the help that like Home Depot associates seem to offer people is like really underrated. Like there's a story in the book about some of the early days of Home Depot, and this guy's like playing golf or something with the Home Depot founder, and he's saying, Home Depot is just it's not going to work. Like I went in to buy a $200 tap that I needed the other day, and one of your associates told me that I just need this washer for like 99 cents and I can fix it. Like you're not going to make any money doing that. And the founder's kind of like, well, where are you going to go next time you need something for your house? He's like, Home Depot. Oh, of course. It all makes sense now.
There you go.
Yeah.
Smart.
All right.
All right. Should we move on? Oh, this is one that I want to ask both of you boys, especially after we were hanging out with Sir Matthew Peterson over in the United States. Have you been able to sell options on US shares in Australia? And I'll extend that to Australia and New Zealand. If yes, how? Do you guys end up putting that plan into action after we spoke to Matt Peterson?
I've been spending a bit of time going back and forth with my accountant just to check the tax implications, but I will likely start implementing that actually.
Nice. Hamish, you were red hot out the gates. I remember we were sitting down over in the States and you're like trying to open a flipping, what was it, Interactive Brokers account. You're like, they're asking me so many bloody questions. I know, it's just let me do my options trading, dude.
Yeah, there is a lot of
huge.
There's a fair bit of tax complexity that goes with it, and I'm a man of simple. I like things that are simple. I like having one focus. I like my accounts simple. So it definitely adds an element of complexity.
T-shirts.
Black t-shirt,
one focus, one girlfriend, one that.
No, zero. And then if you look in my cupboard, the perfect number. If you look in my cupboard, it's just all black t-shirts. So that's why I'm always wearing black t-shirts. What were we talking about? Yeah, so I like simplicity. So that's held me back a little bit, but I set up the account. You can do it through, in Australia, Interactive Brokers. I'm not sure if you can, what other platforms offer it, but the major banks don't offer it anymore. They used to, but they don't. So Interactive Brokers. So I've set it up, but I was waiting for tax to kind of finish my taxes for the last financial year before adding another headache to my tax return for the foreseeable future.
Yeah, fair enough.
But certainly it's something that I want to use. It makes logical sense if you understand what you're doing, which it is complex. So it's certainly not for I think the average person probably, but if you know what you're doing, then it's a strategy that seems to make sense.
It can definitely be done. From what I understand, the tax implications are actually probably a little simpler on Australia than New Zealand. In New Zealand, we have this weird thing about whether you're an investor or a trader, and you have slightly different tax treatment, and it's a real grey area which category you fall into sometimes. But
right.
Yeah, like I've had Mitch and Castole. I'm not sure if you guys follow them on Twitter, but I've had them on my podcast a couple of times. They're an Aussie couple, which
I saw that.
They've done a fair bit of stuff with options and had success. So
nice.
Could definitely be done.
I don't think I'd call us options traders. That's for sure. All right.
Yeah. No. Yeah, I mean the Peterson strategy is like using them as a tool to get a slightly lower cost basis when you buy a stock and capture a bit of premium on the way out. They're just tools to get in and out of your regular boring kind of long-term holdings.
Yeah, it's not actually options trading. It's value investing, but utilizing options to do exactly what you said. Yeah. Okay. How do you determine how to buy your tranches? Do you say buy the first tranche at 50% margin of safety, then a second at 75% margin of safety, etc.? I've spoken about this a little bit before. I think we've spoken about this, Hamish. I don't have a hard and fast rule. I'm wondering, do you have kind of any principles or any ways that you think about it, Tom? Or you just kind of go with the flow a little bit?
Yeah, this is one of the things that's actually changed like a bunch over time for me.
Okay.
I would say, and again, I don't really have any hard and fast rules, but typically I would try to break a purchase into at least like two different kind of purchase events, I guess.
You thinking like roughly the same size, or is it more like, I'll just dip my toes in and see how I feel about it, and then if I'm feeling good, I'll really go into it? Or how do you?
Usually the same size, but I think there is a very real psychological thing to where once you actually own shares in a business, you pay a lot more attention to it and follow it much more closely and stuff. So there can definitely be a bit of conviction building between those purchases and things as well. And there's lots of other factors that go into it outside of like the price goes down a certain amount and I should maybe add more or whatever. Like this year I've added to businesses that have been in my portfolio for like almost 4 years and stuff that I haven't bought for 4 years, just because prices have come down or whatever. And you kind of have to stack it up against like other opportunities that you've got in your portfolio. Like you might be thinking, I'm going to put a certain amount of money into this particular stock over the next couple of months, but then some other business pops up or some other stock in your portfolio gets cut in half and suddenly your like opportunity set changes. So there's not really a super simple framework I could give.
That's kind of what you go back to, isn't it, Hamish? It's kind of like where the opportunities, where should you be putting your money, that kind of thing is more the framework that you kind of adopt, right?
Yeah, I do like to dip my toes into pretty much everything that I buy before it's got into a really good price. And when I say dip my toes in, I mean like literally like 1% of the portfolio or like 2%. And it is what Tom kind of spoke about. It's more psychological, so that I own a piece of it and I'm going to pay more attention to it. Rather than, thoroughly enjoying the price that I'm buying it at that particular moment. But then, once it's within a range, I mean, I don't think you can have a fixed, I'm going to buy here and then here and then here. I think as long as when you're buying aggressively, you are happy with the price, then, once it's into that range, you should be fairly aggressive with it. You shouldn't be trying to time the market and think, maybe it's going to continue to get worse. I tend to break my investments up into a few different packets, but that's more, I invest a significant amount, and then if it does happen to get cheaper, then I'm obviously happy to contribute more to that. It's not that I'm kind of timing the market or anything like that. So, but I'm generally pretty aggressive once it gets into a range that I'm happy with. I'm looking very quickly to build that position out to its maximum, because it's already reached a price where I think that I can do very well on it, and it has a margin of safety. So as long as those two things are satisfied, there's really very little rational reason to wait. Maybe that means you do end up missing out on it falling a little bit further, but you can't predict that that's going to happen. So you just have to be confident when you're at whatever price you are buying it at.
Yeah, the thing where I've seen people get into trouble with this type of stuff is they build a full position straight out of the gate, and then the stock gets like cut in half, and then they're like, oh, this looks really interesting, maybe I should add some more, and then all of a sudden it's like a 50% position, and you're like, what the hell have I done here? I've seen a lot of people do that with Alibaba, for example.
Yes.
Like I think you have to have a cutoff at some point and go, okay, there's a possibility I might be wrong here.
Yes.
I'm not a complete genius that knows everything. So that's the other just word of caution I would put out there.
Yeah, I definitely wouldn't go 50% on a single stock. I think you'd have to have some serious level of conviction to put 50% of your money in. And you're right. It can be tempting to do that if you have this value mindset and you just think, I'm just averaging down. But my average price is so good now. that is like a psychological trap I think some value investors fall into. I think most people, if the stock falls 50%, rather than doubling down, they just cut the loss, which is another potential mistake. But definitely both sides are mistakes, and you have to, pre-establish how much you're going to put into that position so that you don't fall into that trap. That's for sure.
And the like 70% position from various averaging downs may work spectacularly, but you don't want to be in that situation if it goes the other direction.
Yeah,
works 100% of the time, 20% of the time. Oh dear. Yeah, I think basically what you guys are saying is that I should fucking mortgage my house and just buy Bitcoin. Is that right?
Yeah. Exactly. Sell everything, buy Bitcoin, mortgage your house.
Michael Saylor style. Sell all my belongings, right? All the business income straight into Bitcoin. All right, cool. Thanks, guys.
Yeah.
Thanks, guys. # not financial advice. Yeah. Okie dokie. Let's do. What's this one? Oh, yeah, this is an interesting one because this is something that I used to do and my approach has definitely changed. Hello, could the three of you comment on the Philtown approach of mixing value investing and technical analysis? I think this is talking about the first book, Rule 1. I find the approach very confusing in practice. I prefer to stick to classical long-term investing and position sizing, even if catching a falling knife hurts from time to time. So I think this is referring back to there's a chapter or two in Rule 1 which says, do your value investing stuff, but also you can look at the MACD, you can look at the stochastics, you can look at the moving averages, and you can, line them up and make sure that you're only buying when all of the big money is flowing back into a stock, and then you sell when it's flowing out of the stock. And I think specifically he talks about doing that within a Roth IRA. And I think that's actually a big component of that kind of approach, because all the stuff that happens inside those accounts is just tax-free. But obviously if we did that, we would cop quite a few tax implications, I would say, which might put a damper on things. But anyway, long story short, what are your thoughts on this mix of technical and fundamental?
Go first.
I mean, I don't use technical analysis at all. I've never found it particularly compelling. I think it goes back to what we were talking about before, where when I started investing, I looked at a lot of different ways that different successful investors go about it. And there are a number of people who use technical analysis, and I just never found any of it particularly compelling. I found it much more compelling that it really doesn't matter what the price does in the short term. Sure, theoretically there could be some way that you could avoid some of the downs and ups that do kind of impact your long-term return. But what's going to drive the most value in your investment is going to be approximately what price you paid for it, and then where does that business go in the future. So understanding and spending time on that process is much more interesting to me, rather than maybe trying to save myself a couple of % here and there on the entry and the exit by kind of buying in and out. And I just never found it particularly compelling. And this kind of approach, if done, maybe it can be done successfully, but if it was done unsuccessfully, maybe it means that you end up selling out of a business when it's already at a price that you would be happy to be investing at it and that would be a disaster. So again, coming back to simplicity, I think I just like the simplicity of focusing on the business and ignoring the stock almost entirely, except for what price I'm buying it at, obviously. But besides that, doing kind of zero trading or any of that. What do you think about this, Tom?
Yeah, I have basically deleted the back third of Rule 1 from my mind. So I'm more or less in the same camp. And if you were to use that like Matt Peterson options overlay, I basically think you can't really use the technicals either, because you're getting put shares in a company if the price goes down or whatever. So that's where I'm at.
Yep, fair. I agree. I do not use them anymore. Although I did find them interesting, and apparently a lot of YouTubers are making like $100,000 a month by technical analysis. So I think that's something we should definitely look into.
Can I learn that through any sort of course? Do you know?
Yes, actually, I saw a few pop up the other day. I'll have to go and find them, and I'll link them to you, Tom.
Okay,
I'll link them to you off air. Yeah.
Hopefully there's a Christmas sale.
Yeah, you know what? Actually, now that you mention it, I think there might be.
Unbelievable.
And it's something crazy too. It's like 80% off. Just unreal. So now instead you're only paying $999 for the course. So it's like an absolute steal.
Yeah. Make 1% per day. 700% compounded over a year or something like that.
Yeah.
So
It was like, How long do you if you make 1% a day, how long do you have to until you can retire? Isn't it like less than a year or something?
Yeah, I don't know.
You like start with $1 or something.
Not
making
long.
1% a day. Yeah, it's not long. It's dumb. It's stupid. It's so stupid. All right, Hamish, you want to send one?
Yeah, let's have a look. How do you know if a company is undervalued and worth investing in? How do you know?
Ooh, good one.
How do we do it?
How do we do it?
You get
Discounted cash flow analysis.
I was gonna say you get a tingly feeling in your left big toe, but that might not be it. Yeah, no, it kind of depends on the company. Like, for your typical like compounder bro, steadily growing type stock, maybe it's a discounted cash flow. For a financial company, maybe you're paying more attention to book value and reinvestment rate and dividend payments, and then maybe for a real estate company, you're focusing on like the net asset value or liquidation value. So a few different approaches. Just depends on the business a little bit. But underlying all of those different approaches, you're not trying to buy $1 for 95 cents. You're trying to look for significant discounts. So it should be obvious.
Yeah, I found, I think Monish said this recently, that you can figure out fairly accurately what the liquidation value of a company is, but it's very difficult to figure out, accurately what the actual intrinsic value of the business is, so what the future cash flows will be. So I think finding a company that's undervalued isn't really about figuring out what the intrinsic value is exactly. It's about coming up, at least for me, it's about coming up with a extremely conservative model that is very likely to occur. So a model that presents intrinsic value as it being far lower than what is likely the reality. And then if I'm able to buy far below that, then I can be extremely confident that it is undervalued. So I can be confident that a business is undervalued without knowing particularly where intrinsic value is for the company. So I think that's an important distinction. Is I'm not trying to like shake my crystal ball and be like, okay, cash flows are going to be this. It's more of a process of what's a really reasonable, safe case that seems reasonable over time, and maybe hopefully they'll far exceed that. But can I buy the business with this kind of base case in mind?
Yeah,
at least that's how I go about it. But yeah, that's
no. I think that's smart. I mean, you definitely go through all the steps. You definitely do the discounted cash flow. You're not just
Correct.
like, PE is so low. Yeah, why not? Let's go. But you definitely do all those steps and you try and get as accurate as possible, and you really think about growth rates and stuff, and you figure it out. But at the end of the day, it's got to be obvious. Like, it's got to like whack you in the face and just be like, yeah, that makes sense. I'm buying it from what I can tell a lot cheaper than what it's actually worth. They're the ones where you're just like, I don't know, it gives you that confidence, that real conviction, that real confidence where you know that, okay, even if I have made a mistake here, even if I've made a large mistake, then I probably won't get crucified. I'll probably, hopefully, stocks can go to zero. They can do that. But it's definitely, when you hit that real big undervalued stock, then you're like, oh yeah, okay, I feel better about this.
Yeah, for sure.
All right, cool. Should we do maybe a couple more? I'm trying to think how long we've been going for. Yeah, maybe. Well, I think we're getting kind of through most of them, so we just did that one. How about let's do this one here. From which people did you learn a lot of what you know, and why? Do you have any book recommendations? So maybe we'll just do a summary. Like, I think because most of the people we look up to are going to be the same. Maybe who are the people that influenced your learning the most, and what kind of books do you think influenced your learning the most?
Do you want to go, Tom, or do you want me to go?
Yeah, I can go. We're probably going to have a lot of overlap here, but yeah,
there will be a lot. All three of us, there'll be a lot of overlap for sure. Yeah.
Early days, it was definitely Phil Town. I'd probably even still push people towards those the Phil Town books if you're like absolute beginner.
Basic frameworks. Yeah.
Yeah. I guess the evolution was kind of like Phil Town, then for Brian Guy Spear, then kind of direct to Buffett and Munger. I think that's very hard to beat. Like the Buffett partnership and Berkshire Hathaway letters. So I would definitely recommend that. Poor Charlie's Almanac up there behind me is pretty good too.
Hey.
Yeah, they're all good places.
What's like one investor that you never kind of thought that you might learn stuff from? Like, what do you have one that's kind of a little bit out of left field that you're like, I never thought that I would learn about this investor, but actually some of the stuff resonates, or no good examples?
I mean,
or a book or something like that.
Nothing is springing to mind, honestly.
No, that's all right. That's all right.
Yeah.
I mean, definitely Nick Sleep. I know I talk about him a lot, but it's just refreshing because it's such a modern kind of example of someone who not only is applying, I think like pretty much Charlie Munger style principles or modern kind of Warren Buffett's high quality businesses, but also demonstrating in detail his thesis on those companies through his letters. That's really rare. You get to hear from interviews, other value investors and kind of generally what their thesis is on companies, but Nick is one of those people who very rare people who goes super in depth, not only into the company and the competitive advantages and the management team, but the valuation and how he's projecting out. I've never seen anybody give that much detail. I mean, he was talking about Costco and how he was measuring the population density, and I think it was Seattle or wherever they started, and then it was expanding the number of stores across the US, and it's like step by step exactly pretty much how he valued the company. And that's really been really valuable to kind of go through that, even though the only downside to Nick Sleep is that he's only focusing on kind of one type of competitive advantage, which is that scale economies shared, whereas there's obviously many other different types of businesses and different types of competitive advantages that you could learn about. So, yeah.
Yeah, I think I'm the same as you guys pretty much. The thing that one that I guess still pretty everybody reads it. Peter Lynch, One Up on Wall Street. I think Peter Lynch is the one that really gave me the sense of what I was saying before. How it's just like it's got to be obvious. It's just like just sit back, use your brain. You should be able to explain the thesis in 2 minutes to a 10-year-old. It should be quite clear, quite obvious. Don't fall into any of these psychological traps. Don't buy it because of this reason or that reason. Just have your thesis, work out your valuation. It should just be like, this is clear, this is obvious, and I think that's one that comes to mind. But beyond just all the classic Town, Guy Spear, Monish Pabrai, Warren Buffett, Charlie Munger. Yeah. All right, cool. What's a good book you guys read in the last year or so that you can recommend for people? Maybe people want to read something over the Christmas break, investing related or business related, just generally.
Phil Fisher books are really good. I haven't finished it, but I'm reading. Oh my god, the names of everything are I'm blanking on me today. But one of Phil Fisher's main books is
Common Stocks
really
and
interesting.
Uncommon Profits.
That's the one. Yeah. So there's a lot of valuable principles in there, and it's kind of one of the people that Buffett talks about as being an inspiration for some of his investing principles. So there's a ton of value in that for sure.
Yeah.
Tom, you got a good book. I think one for me that I always go back to, and this is more like just like being a better person, being a better communicator, is How to Win Friends and Influence People. I've read it before. I've read it a couple of times before, but that one always just stands out. It's just such a good book. Such a good book. I'd definitely recommend that.
Yep.
What about you, Tom?
Yeah, earlier this year
Sorry, just quickly, what was the Home Depot book you were reading?
Yeah, sure. So it's Kick Up Some Dust by Bernie Marcus.
Okay. Yeah.
I think it's just very recently come out, but it's a pretty quick read. It's really good. I think Bernie Marcus is like into his 90s now, and someone convinced him to write an autobiography. So
he must have watched a passive income video on YouTube.
Exactly. Yeah. So lots
his
of cool
ebook empire.
Yeah, exactly.
Earlier this year, I finally got around to reading The Outsiders by William Thorndike. I'm not sure if you guys have read that before.
No, I've not.
Yeah, you guys should.
What's it about? What's the gist?
Right after this podcast, I think that's like a must read for all investors. It's like a case study. So I think there's 7 or 8 chapters, and it's case studies on really successful public company CEOs with kind of a focus on good capital allocators. So Warren Buffett is one of the chapters. It also goes into the story of Henry Singleton. I'm not sure if you guys are familiar with Henry Singleton, but he's a guy that built a really successful conglomerate, and he was like the master of managing his like share capital. So when he was first building the business, he'd like issue shares. These numbers are going to be off, but something like issue shares at 20 times earnings to buy private businesses at 10 times earnings, and he'd just kind of run that engine. And then the equation kind of flipped later in his career to where his stock was trading at a much cheaper multiple than he could buy private companies at. So he ended up buying back 90% of the shares outstanding. And it's just like, insane home run. He like never talked to analysts or anything. Everyone thought he was a little crazy, and he probably was. And there's just lots of chapters on other CEOs. I think Tom Murphy, who ran Cap Cities, is one of the chapters. He's like a CEO that Buffett has really admired. John Malone from the Liberty Media Complex is one of the chapters. That would definitely recommend that. So The Outsiders by William Thorndike. And this is a bit of a random one, but if anyone's interested in understanding banks, which I managed to get into that rabbit hole earlier in the year, the Bank Investor's Handbook is actually fantastic. So less dry than you might expect.
Yeah, I would like to actually, because I just know absolutely nothing about banks. Like, I'm so bad. It's probably just good general knowledge anyway, if we're talking about stocks and finance, just to have a better understanding of something that's so integral to the system. All right, cool, gents. GG.
All right, wait, hang on. We've got one more question. Do you think IQ is correlated with penile length? Really important question.
Yeah, this is one of the weird ones that we were like, I don't know if we include that. Do you think IQ is correlated to penile length?
Tom, any thoughts?
Yeah.
No, I have nothing to add on that question.
Nothing to add.
It can't be true because my IQ is really low. So we'll just end on that note. Thanks everyone for tuning in. All right.
Merry Christmas, everyone.
Yeah, we will wrap it up there for today. Thanks everyone for tuning in. Hope you put up with us while we're having a little bit of a break over Christmas, and hopefully you enjoyed this episode. We will be back. I'm not sure what we're going to do over New Year's. We might have another, maybe another pre-recorded. We'll kind of see, but certainly we'll be back next year for more episodes of the Young Investors Podcast. Thanks everyone for tuning in. And thanks everybody for joining me today, Brandon and Tom, special guest. Have to have you back on again soon.
Thanks, mate.
But with that said, have a good Christmas and New Year's. We'll see you guys next week. See you guys.
Bye-bye.